Welcome to the TSP Weekly Podcast. I was going to start like I was going to do the Gridcast or something. I'm your host, Scott and Bruce.
Gridcast.
Back in the day.
That's a blast from the past.
I know.
Actually, I think we had a government shutdown during the Gridcast.
Yeah. That's when you know you've been around a while, when you've been through a few government shutdowns.
Yeah. Yep. This one is
going
to be,
for us this week, man?
This one's starting to drag out. It's starting to be a bit of a problem. Next week will be the 15th, so we'll see if the military gets paid next week. And it's going to be interesting. And I got a slide on some of the things that the economists are not getting because of the government shutdown. There are a bunch of agencies that the Fed and other economists pull information from to make, predictions and expectations of what the market's going to do going forward. And a lot of that we don't have now with the government being shut down. So we'll take a look at a slide on that in a minute. But we'll take a look at the weekly economic highlights, at least the ones that we have access to. We'll take a look at some Fibonacci upside targets. So there are a whole bunch of ways to project how high the market might go. And one of them is Fibonacci upside targets. We'll take a look at that. The F fund and the Fed funds rate. So the F fund is definitely something to watch. We use it as a tool. When the stock funds are going down, under certain conditions, the F fund can really be spiking up. And so since we kind of have an idea, we know what's going to happen with the Fed funds rate going forward. I mean, the Fed is in they're lowering rates, right? They're in the process of lowering rates. Everybody believes the Fed's going to lower another 25 basis points in October at the end of the month. So we'll see what happens when the Fed lowers rates. And then the TSP fund direction. All right, so weekly economic highlights. So we talk about the bond auctions all the time. Some of the bond auctions, again, this was just like last week, some of the bond auction rates went up this week for the first time in months. Last week, that was the shorter term bonds. The 3-month and the 6-month were actually up a little bit last week. This month they're down a little bit, but the long bonds are up a little bit this week for the first time. So, but yield on the 3-month and the 6-month was down a little bit. That's actually a good thing. The less the government has to pay in yield, the less we're adding to the deficit, right? That's the whole idea of this. And by selling more 3-month, 6-month, 2-year, 10-year bonds, that's how the government raises money. And the cheaper interest rate you can pay on that borrowing, the better off it is for the federal deficit. And so far this year, it's been really good, but the last couple of weeks, it's been starting to, rates are starting to pick up. So we had a 3-year, a 10-year, and a 30-year bond auction this week versus last week. And the good thing the bad thing really for the longer term bonds, so definitely the 10 and the 30, is you're paying a higher rate this week than you paid last week. Okay, so this is the first time this year that we've started to see the government having to pay higher yields from one week to the next. The positive part of this is that the yield curve is not inverted. So for a long time, last year and the year before, it was inverted for almost 2 years. The 3-year yields would be a higher rate than the 30-year yield. So you would expect, if you're going to lend the government your money for 30 years, you want a pretty high interest rate for that. And if you're only going to lend it to them for 3 years, you'd expect a lower interest rate, right? That's a normal yield curve. But over the past few years, the yield curve has been inverted, and the shorter term bond yield was actually higher than the longer term bond yield. So that uninverting is what people worry about recession, which we haven't seen yet. But you can pretty clearly see now the shorter term yield is definitely less than the longer term yield. Big scheme of things is going to be better, but in the short term, it tends to predict a recession. 30-year mortgage fell a little bit to 6.43 from 6.46 last week. And new applications were also down another 4.7% after being down 12.7% last week. So mortgages still not looking good. We get the Fed meeting at the end of the month, right? It's the 28th and 29th. So on the 29th, the Fed will come out and almost guaranteed to cut another 25 basis points, or 0.25%. The cut is expected due to continued concerns of weakness in the labor market. And the intention is to lower borrowing costs to encourage hiring, because we're not so much worried about inflation right now. We're worried about hiring and the economy slowing down. So that's why the Fed is looking to cut rates rather than hold them steady. This is kind of the problem, right? Since the beginning of October, we're not getting a whole lot of data that economists really need to try to figure out which way things are going. And so it's a little bit of a crapshoot right now, because there's some really, really important information we're not getting. Non-farm payrolls is a huge one. Initial jobless claims, retail sales and industrial production, GDP, right? We're not getting really important data as long as this government shutdown continues. So as much as we fly blind as it is, we're flying blinder with none of this data coming out. But we still have this upside targets. So Fibonacci upside targets. This is a chart, a weekly chart of the S&P 500. So each one of these ticks is 1 week. And we're going back to a little bit before COVID here. So we're going back to 2019. So Fibonacci targets work really well. You use Fibonacci for basically two things. You're looking for a retracement or an extension. So let me take this one first. For a Fibonacci retracement is a term that we use a lot. If we start at a peak and come down to a bottom, so the market fell from COVID. As it starts coming back, it's hitting these retracement levels, which I don't have drawn in. Okay, so as it crosses through these retracement levels, eventually it gets back to the prior peak. Once it gets to the prior peak, then instead of retracement levels, we use extension levels. So once we got back to the prior peak from COVID, we had some churning, and then the market kept moving higher. And the first extension target is 1.618. So what that is if you take this length, the length of the pullback, and multiply it by 1.618, then from here to here is that number, is that target. And you can see we hit it and had some churning, but then the market was pretty strong. The trend, it kept on going, got a little bit higher than the 2.0 Fibonacci extension, because that's the next extension level. So we got to a little bit above 2.0 and rolled over into that 2022 bear market. Once we got back above the 2022 high, right, then the target became the 1.618 of that 2022 move down. And we hit it, pulled back quite a bit, and then rallied again up to that 2.0 level, right? And then rolled over to another 20% decline into April of this year. So if the retracement levels hold, when we get big pullbacks like that, it's pretty valuable. If we try to do a Fibonacci extension from like these little pullbacks, it's not really as valuable. But if you do them from big 20+% pullbacks, they tend to work. So we're looking at an upside target of 1.618 at about 69.50, and the 2.0 is about 74.50. So somewhere in there is where the S&P, the C fund, is likely to roll over and have our next pretty significant downside. There's no guarantees that we're going to get, certainly that we would get to that 2.0 extension. It's likely that we get to this 1.618 extension, but these are just targets, right? It's not a crystal ball. It's targets, and it's one way of doing technical analysis to try to anticipate where things are likely headed. And you can see it works, but there are no guarantees that it's going to work every time. Okay, F fund and the Fed funds rate. So this is a long-term chart of the F fund, right? It goes back to 2003 and 2022, right? This was the peak here in 2020. From 2020 to 2023, 1, 2, 3, 4, 5, and we lost any gains that we had since the very beginning of the F fund are gone, right? We're pretty well below where the F fund started in 2003. So a lot of people look at that and say, well, that means that now the F fund has to be really oversold, and so it must go up from here. The problem is that the F fund tracks the aggregate bond index. And so the actual, if you looked at the 10-year yield or the 10-year bond instead of the aggregate bond index, which is a relatively recent kind of creation, you would see this going all the way back and going all the way down. So this is actually a long-term top. And this is just the beginning, probably, of a decline. There are a lot of people that think bonds are in trouble for decades, and you don't have to try to get on board with that and agree. You just have to follow what happens with price. So we are at an all-time high here. Let me fix that. All right. We were at an all-time high here in 2020. We came down 1, 2, 3, 4, 5. So that's a first step down. We're in some kind of recovery process right here. So the idea is that the next move is down. But we don't really have to try to anticipate that, because we can look at it and go, okay, if we get below this level, certainly if we get below this level, the next move is down. If we get above this level, it's very likely that this is a rounded bottom and the next significant move is up. So as long as we just keep looking, keep an eye on the chart and see which way it goes, right now it looks like a flag pattern and it looks like the next move is down. Okay, so that's how I'm reading the chart. If we overlay the Fed funds rate, so every time the Fed comes out and says it's going to raise or lower rates, all it's doing is raising or lowering the Fed funds rate. And so generally, when the Fed raises the Fed funds rate, the F fund goes down. When the Fed lowers the Fed funds rate, the F fund goes up. So where we are right now, we've begun a rate falling cycle. So we should be in a bond rising cycle, right? That's kind of the theory of it. And generally that is the way it goes. The concern is this part right here. So in 2007 and 8, you can have the Fed cutting rates, right? There's the Fed cutting rates. For a little bit, bonds go up, but then everything rolls over together, right? So you got the same thing in COVID. Fed's cutting rates and everything's rolling over together. So it's just something to kind of, you have to know the environment that you're in. It's not every time the Fed cuts rates, the F fund goes up. There are other things that factor in. It's just like, it's not every time that the dollar goes down does the I fund go up. There are a lot of things that go into the mix, but you can see generally when rates go down, the F fund is going up, right? When rates go up, the F fund is going down. Okay, direction TSP fund. So this is, again, the C fund weekly chart. We got the 20-week moving average line in blue, relative strength index, and MACD. So the trend, as long as we are above that 20-week moving average line and price comes down and finds support at that line, the trend is up. Once we break below that line on a weekly basis, that's the first big red flag that the trend could be reversing. And then we get a couple weeks here, right, of resistance. Price can't get back above that 20-week moving average line, and that's the beginning of this downtrend, right? So once we gapped back above that 20-week moving average line after the April bottom, we've been in this really tight channel going forward. And until we break out of that channel, the trend is up. There's all kinds of reasons to be concerned about the continuation of the market moving higher. But the reality is the market is moving higher. It doesn't care about government shutdowns. It doesn't care that, the top 10 stocks in the S&P 500 are the same top 10 stocks in the NASDAQ 100. It doesn't care that the leading economic indicators are at the lowest level relative to everything else in the history of the index. There's so many things you can point to say why the market should be rolling over from here. And a lot of people do that. But the fact that the price keeps going higher is the only thing that should matter if you're a TSP investor. At the same time, you don't want to get hung up in, oh, none of these things matter anymore. Price just keeps moving higher. Eventually, these things will matter. And so following the price chart is the most important thing.
Yeah, that's really what I've seen.
All right, if you guys like that kind of,
I'm sure you're seeing a lot of it, is that people are just starting to believe, oh, well, none of this stuff really matters. It's, yes and no, right? Optimism is at its highest, right? That's pushing a lot of things. A lot of people are optimistic about AI and tech and all of these things. And if you were around for the .com boom and the bust, you've seen this kind of stuff before. I'm not saying there's going to be a bubble again. It's going to burst. But every single person, I think, out there that does any sort of market analysis tends to agree that it's on its way. We just don't know when. Well, that's kind of the case always, right? We're going to have a correction. So really what I'm doing is kind of reinforcing what you said, Jerry, is it's never a time to take your eye off this stuff, but right now you certainly don't want to. Because if you're not paying attention, it's going to roll over. You're not going to see it coming, and you're going to second guess it, right? You're going to say, well, no. It's going to come back. It's going to come back, and you're going to watch it fall, and you're going to be in very painful position. So if you don't follow us, follow somebody that's talking about this stuff, because you've got to keep your eye on it. Nobody wants to see a 30 or 40% reduction in your retirement account, especially now. Things are a little squirrely,
It's just not necessary either. That's the thing. I mean, if you look at a couple of moving average lines and a relative strength indicator, you can avoid the vast majority, of the down moves, as long as you say, okay, you don't get sucked into it. It'll come back, right? If you just reallocate to the G fund, and then if it turns back around and keeps going higher, get back into it. But at some point, it's going to be the time that that was the trigger and it drops 10-20% in a couple of weeks.
All right, guys, if you want to hear more stuff like this, go to our website, growmytsp.com. If you have any questions about anything you saw on the show today, put it in the comment section wherever you find the video. And if there's no comment section, just shoot us an email, support@growmytsp.com, and support team will get it to us. Hope you guys are having a great weekend, and we will see you next week.
Later.